Alright, go ahead and get started. Talk. We're going to talk this week about risk assessment, which is a part of the planning process in audit. I know I've bitched about this before, talking to you guys in the brief time that I've talked with you in person, just about the way that auditing class is set up in general and the way the textbook is set up compared to what actual audit work is and the CPA and that type of thing. So I don't know if anyone's read this chapter yet, but if you do, read it, and when you read it, and when we go over the slides today, you'll see that one thing that auditing textbooks are very good at is overcomplicating things. So this chapter, I think you could probably, I think most of you would just automatically do most of the stuff that's in this chapter just naturally if you were asked, hey, let's assume that none of you have any accounting training at all, and someone just comes to you and says, I want you to go look at this company and try to determine if the information that's on their financial statements is accurate or not. Now, obviously, you probably wouldn't feel terribly comfortable doing that if you were not an accounting person or didn't have an accounting background at all. But after you got past that mental hurdle and decided to go ahead and try to do the work yourself, you would probably come up with a plan that was at least, I'm assuming you all are just competent humans. I know most of you, so I know that's fairly true. The plan that you would come up with would just be common sense. You would look at the business and you would say, hey, there are unique risks associated with this business. If I'm dealing with a retail business and they're asking me to check their financial statements, and there's, the way that they generate revenue is at the point of sale at a cash register, and a lot of cash changes hands. Obviously that place where all that cash changes hands is going to be a red flag that's unique to that business or that type of business in terms of what is risky behavior for that business. So what this chapter does is it basically, and the book does this in general to some extent, but it kind of tries to almost put in mathematical terms, or at the very least in kind of a formulaic pattern, how to do this stuff, when most of the time y'all would just kind of naturally do it in kind of a common sense way. If that doesn't make sense, you'll see what I mean as we go through these slides. Okay, so I guess as we go through this book and this particular lecture specifically, there's a couple different things that y'all should be looking at. One, the takeaways, since most of y'all are going to be taking or trying to take the CPA and pass that, obviously you should be looking at everything you see in this class in terms of what is the possibility or what components of the things I'm looking at are items that are likely to be tested on the CPA exam. And for audit, basically what that is every time you're given a list of, these are the 5 different whatever, or these are the 7 different whatever. And the audit is all about memorization. So anytime your book gives you a list of different characteristics of something, or we're going to talk about various different kinds of risk, in the real world, maybe knowing the actual terms associated with these things is not that important. When you get out to work and you go work for an audit firm, the fact that you don't know whether it's engagement risk or audit risk or whatever the nature of the risk is, that's kind of going to be irrelevant. No one's going to be like, hey, you didn't know that was the right name of the risk when you were doing the planning engagement. No. the terms and all of that stuff is really only going to be important, at least at the level that you're expected to know it for the CPA exam, only going to be important for the CPA exam. When you get out there into the real world, and you'll be doing this stuff, and depending on where you work, everywhere will have their own little, nuanced way of handling the planning. But for the purposes of this class, the quizzes, the exam, and I'll write the questions for the quizzes or exams that come from the textbook, and what your textbook likes to test on is these formulas. Okay? So with that in mind, audit risk, the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. What that basically just means is if an auditor says these financial statements are good to go, but they're actually not, that's the risk that you're taking when you're talking about audit risk. Saying it's good when it's not. And, of course, the other way around as well, but this is the bigger risk, saying it's okay when it's not versus saying it's not okay when it really is. Your book talks about, again, this kind of audit risk model. And, again, I hesitate to even talk about it too much because it really is overcomplicating things, but I will talk about it briefly here. These components of audit risk is basically the overall risk to whether the audit was done correctly or not, right? The auditor's job is to provide an opinion as to whether the financial statements are likely to be materially misstated or not. So overall, whether the auditor got that right or wrong is what the auditor is. And so that is a combination of these other types of risk. Inherent risk times what was it? Control risk, yes. Control risk times detection risk. You can see I don't even use the terminology. And detection risk, really, these two together basically just mean the risk that is already there, right? The risk that you have no control over as an auditor. So that's a combination of, control risk is basically just based on the system that's already in place. Is there a good enough system in place to where if something had been done incorrectly, that it would get caught by the system that's in place? Okay? So if there's a great system in place, the fact that you may have had an error pop up would be a non-issue because that error would have self-corrected based on the high level of controls that you have. So as controls go up, the higher the level of controls that already exist. I guess let's talk about this in terms of risk. Okay, since these are all talking about the risk associated with these. As the control risk goes up, so in other words, the level or quality of controls that are in place is poor. So as that level of risk goes up, obviously the magnitude that risk is going to be associated with will have a lot to do with the inherent nature of the business, right? So if I have no cash associated with my business, but I have the best cash control system in the world, the fact that my control risk for cash is really low basically makes no difference because I don't deal with cash in the industry of the business that I'm in, right? So the combination of the inherent risk associated with the business, which would be the IR, and the steps that business has taken to ensure that any errors are caught, which is basically going to be control risk. The combination of those two are the uncontrollable risks associated with the financial statement. And then finally, what you as an auditor can control would be detection risk, right? Detection risk is just the risk that that these errors exist in the financial statements, but that you as the auditor are not going to detect them based on flawed tests or flawed planning or some other auditor error, anything like that. Or even if you are perfect at being an auditor, you've done everything exactly right, you planned the audit right, you performed all the procedures correctly, even in those scenarios, there's still a risk because of the fact that we don't look at every single transaction that occurred. There's still a risk that you miss something, right? Anytime you are sampling and not looking at every single transaction, there's a risk that you're going to miss something. So, in the planning process, as an auditor, since this is the only component that you can control, you're going to have to ratchet that up or down. Since we're talking about risk, improving detection risk actually means lowering risk, right? So we're going to lower risk by increasing the amount of tests that we do, right? So to the point where if we wanted to be 100% sure that we caught everything, we would have to test 100% of the transactions. Okay, so as a professional auditor, I'm going to look at inherently what's going on with the company, both in the nature of the company and also in what they've set up proactively to control the inherent risks. And based on what I see there, I'm going to determine how many tests, what nature of tests I need to provide to ensure that whatever this number is, it equals out to an acceptable audit risk. Okay? So I'm sure as intelligent humans, you all can see how this can be a flawed little model here, because what you're essentially trying to do is turn real life into math, and you could tie a percentage risk to all of these if you wanted to, right? But you would just be guessing at those, right? If you really want to look at this as a mathematical problem, if you put percentages in here, yeah, I mean, it could work out, but these are all just as good as the estimates that you put in there to begin with. And that's the biggest issue I have with it is, this looks all fine and nice if you're into math, but what is this really telling you? This mathematical model is really telling you that as an auditor, you should come into a business, look at what's going on, right? Look at what they have set up, what type of system they have, and if everything looks okay, or it looks like they're doing a good job in what they have set up to ensure things function smoothly, aka the controls, and given what you know about the industry, you make a decision as to how much of what you're going to look at as an auditor. And that, in not nearly as many words, is what this means. Okay? You're going to determine what is an acceptable level of risk, and whatever that level of risk is. Most people obviously are not going to. Most people would do this type of kind of mental arithmetic in their head. You wouldn't actually assign numbers to these things. I think one of the reasons that in auditing we tend to lean towards building these funky models and trying to make it more mathematical than it is, one of the reasons is because a big part of auditing is the records that we keep called the audit papers that are a part of the audit. And so within these records, you're going to keep, as the auditor, the plan that you've made during the audit process of how this audit is supposed to work. And a component of that plan would be some version of the audit risk model. Not everybody would actually write it out in terms like that, but you would see specifically outlined, these are what we believe, or this is what we believe the overall level of risk is. They could say in terms of percentages, you could assign just arbitrary qualitative words like very low, low, medium, something like that. But there is going to be, this process is going to happen one way or the other, and it's going to be included in the audit paper's paperwork. When we talk about engagement risk, this is from the perspective of the auditor, and this basically means what is the risk to the auditor that accepting this engagement is going to go bad. Okay? So if we accept an engagement that ends up going bad, what are the possible negative consequences of that? Well, adverse publicity, if it's a newsworthy event and people are talking about it, obviously it's going to be difficult to get clients in the future. But in addition to that, there could be litigation that comes up. Examples of possible litigation, if you're an auditor, could be, well, just think about who uses auditors' opinions. Anyone who is evaluating a company and using the opinion of the auditor as a way to evaluate that company, if they end up getting a bad deal based on that evaluation, and it's because the auditor was wrong, then they can go to court and try to prove that. Obviously, trying to prove that and actually proving it are different things, but nobody wants to go to court, right? So those risks are definitely risks that the auditors weigh when they're determining, usually, well, throughout the audit engagement, but obviously when determining whether or not to accept the audit, that would be the main time you would be weighing the benefits and negatives of that particular client. This would be the suggested way of using this mathematical way of looking at the audit risk model. Again, I think a lot of this in real life is done a lot more, what's the right word? It's less formulaic. I'm not going to ask you to rearrange the equations or algebraically manipulate anything. Vasily, you're a math guy, right? So you would love to do that, but not today. Not today. Hold back. Wait, you like math too, huh? Not everybody's a math person in here, though, right? Sam? No? Okay. Making sure. All right. It's just a flow chart. This, again, using the book's terminology here. Not sure how much you actually would get out of that flow chart. This one might help a little bit, though. This is where I was talking about a qualitative version of the risk model, where you're looking, instead of percentages or however you want to look at that other one mathematically. For those of you who don't like numbers, it's sometimes easier to just look at words. Describe it, say, okay, what's the overall audit risk? What's the detection risk? What's the risk on the things that we can control? What's the risk on the things that we cannot control? Which would be the risk of material mistake. And how they relate. The key factor there in all of these things, and this is really, I think, overkill to have to write it out like this, but the key factor is if you're in a risky environment, for whatever reason, nature of the environment, nature or lack of the controls that are in place, then you're going to have to do more work to determine if the financial statements are accurate. If you're in an environment that is less risky, it makes sense that you're not going to have to do as many tests to determine if the financial statements are correct. Yeah, like I said, that's basically just part of a tool. The risk model is a tool used in planning. I think if you see anyone write it out like that mathematically, most of the time it would be just for the purpose of keeping a record of it. I think for the most part, obviously there's going to be some exceptions to this, but for the most part, the people that are actually planning the audits have done enough of them that a lot of this is just going to be kind of naturally flows out the planning process. Let's see. I already talked about everything there, really. This would be an example of some just random crap that might be tested on the CPA exam. I'm almost positive that, if I remember right, these anything where you see like a group of 5 things together like that, those are things that they just love to test. Like, do you remember all these 5 factors? So anytime you see something like that in the slides, I would definitely put a little check mark next to it and go back and look at it. Again, I'm not sure it's going to give you a lot of benefit in the real world, but it will help you pass the exam. Okay, so how do we determine how risky the environment is? Well, first of all, an auditor is expected to have some basic understanding of the industry that they're auditing. So to the extent that you don't have that, you would need to kind of brush up on whatever industry it is that you're doing work in. Then an auditor is going to go in, they're going to do interviews, they're going to do tests, observation and inspection. Whenever you see the auditing textbook use the word analytical procedures, that basically just means think about it. So thinking about what you see and what you expect to see based on, for instance, if I walked into somewhere that had, like we were talking about, had most of their business coming from point-of-sale machines where they're collecting cash, then I would expect when I went into their accounting records to see some evidence that this cash is being deposited, however often it is that it's supposed to be deposited. Probably usually be every day, or not working in that type of industry for a while, but maybe if you have some type of advanced safe system, not every day. But whatever the case may be, if you're dealing with cash and you come in and you know you're dealing with cash, then there are going to be things that you're going to specifically have to look at because of that. So that would be what we talked about in some analytical procedures. Do you just thinking about what you have seen and what is inherent in the industry? Is there anything amiss? Does it pass the sniff test? Another great slide here for components that you should know, responsibilities in terms of understanding the entity that you're auditing. Let's see here. You guys, we've talked about what the nature of the entity is and why that is important. Knowing industry, regulatory, and other factors. If you come into, for instance, like if I came in and was auditing a bank, I've never worked in a bank in my life, right? I know the accounting procedures for doing financial statements because that stuff is universal in terms of for-profit entities, right? But I don't know all of the regulatory environment that exists for the banking industry. But I do happen to know that there's a lot of it, right? So that would be an example of some of the industry-specific regulatory issues or environment that an accountant or an auditor in that industry should be aware of. These are just different types of misstatements. We've talked about it before, but how do we determine what's material? Again, that's going to be basically a judgment call, more or less, just based on the magnitude of the misstatement compared to the overall financial picture of the organization. Let's see. Error versus fraud. Both cases of misstatements, one obviously being intentional, one being unintentional. So we treat these kind of in the same way, but also kind of in a different way, because with ultimately, as an auditor, what I'm responsible for is making sure the financial statements are accurately presented. Okay? So if I discover fraud and that fraud does not cause the financial statements to be misrepresented, then I can still issue a clean audit opinion. Just because I discovered, even if it is, obviously fraud is not a legal act, it's an illegal act. So even if it's an illegal act that I've discovered as the auditor, I can still put out a letter that says unqualified, perfect audit opinion. Okay? Why? Because as the auditor, my concern mostly is at the materiality level. So basically, is there any inaccuracy there that's big enough to make an investor or potential investor change their mind about an investment? If there's not, then that's okay. Okay, that's all I'm really being hired to do. Now, does that mean that if I discover fraud, I'm just going to sit on it and not say anything? No. I still ethically am obligated and contractually obligated to go to upper management. If the fraud involves management, then go to the audit committee itself. But I, interestingly enough, am not under any real obligation, barring any type of legal subpoena. I'm not under any obligation to go to the law. I don't have to, as an auditor, go report it to law enforcement. Okay? So as an auditor, my main concern is the materiality of any mistakes or errors that I see. If it's a material misstatement, I have to deal with it, okay, regardless of whether it's an error or fraud. If it is, and I guess we'll get into that in a second here, but if it is not material, then I don't have to put it or make any special statement about it. Let's see here. I guess we're just... Let me go back a slide real quick. All right. So we're just going to back up and talk real quick about just fraud in general, I guess, or I guess the environment in which you might likely see fraud to be committed in. This is called the fraud triangle, maybe? I don't remember. Anyway, these are the three factors that people, academics, have determined exist anytime that a fraud takes place. Incentive or pressure to perpetrate the fraud, which most of the time people interpret that to mean generally some type of financial pressure. So if you see someone at work who, all of a sudden is really stressed about money, car got repoed, or other indicators that they are doing poorly financially, that would be a red flag that they might have some pressure or incentive. opportunity just means, are they able to do it? If do I have a table full of cash in a room with nobody watching? That would be obviously a very large opportunity to carry out a fraud. And then generally this is just termed as rationalization, but basically some ability to justify the fraud, right? And again, this is kind of over-complicating something so we can put it in a model. But obviously, no one is going to do, for the most part, an illegal act of fraud unless they have justified it somehow, they were able to, the opportunity existed, and they were incentivized to do it. So take that for what you will. But I guess one thing that's important to take out of that, planning-wise, is obviously the amount of controls we have in place are going to directly influence the opportunities to carry out fraud. And this could be one component. People that are likely to be incentivized or feel pressure to commit fraud. That might be something that came out during some of the interviews that you were doing. Just talking about the various processes that take place at a business. Let's see. So as an auditor who's in the planning portion of the audit, obviously these are considerations that you would look at if you suspect a fraud or in the planning portion of the audit to try to ensure that no fraud exists. Just kind of running through whether any obvious red flags for incentives to, especially officers of the company or managers, because they're the ones who generally have the most power to commit fraud, but really anywhere that it exists would obviously be something to take a look at. Let's see here. Most of this stuff's pretty self-explanatory. Obviously, it's pretty circumstantial, so it's going to depend a lot on the specific entity that you're auditing. Let's see. I don't want to spend too much more time on the fraud portion here. Okay, here we go. Now, well, it's just a kind of a flow chart taking you through fairly obvious responses at the various points of assessing for these risks. When you come up with risks, or when you encounter specialized risks, there are some different steps that an auditor or the person planning the audit might take. Obviously, if you were the senior person planning the audit, and for instance, going back to my example of like a bank or a financial institution like that, if you know going into it that it's going to require special knowledge, obviously you would then assign the people that are competent with banking regulations and whatever else they need to be specific to that industry, to that particular audit. All right, then at the end of the audit, so at the beginning of the audit, you set up your little model or however you want to do it that sets out the acceptable level of audit risk and then sets out everything you're going to do to ensure that your audit comes out. And then at the very end, either the financial statements are materially misstated or they're not. So if they're not materially misstated, then you would issue an unqualified opinion where you would say, hey, everything looks good. If they are materially misstated, then the first option is to go to management and just make sure that they eliminate the material misstatement. So this is a part of the audit process that a lot of people that have either never been a part of the audit process, from either indirectly or just not familiar with accounting in general, don't seem to understand. But if an auditor finds a mistake that could be considered a material misstatement, that doesn't mean, it's not like a test in school where, hey, we found that and now you failed the test, because the auditor can find that, and then the management team still has time before the audit's over to fix the problem. So if it's just a matter of some simple error, and then you go back in and fix it, you still get an unqualified audit opinion. So a lot of people, when they think about auditors, they think people coming in trying to catch them doing something wrong, when in actuality, if they catch you doing something that's incorrect, they're just going to help you fix it, right? And if it's, obviously if it's something, it could be something that's serious enough, or that has been wrong long enough that you've already put out some financial information that's based on those wrong things, then it becomes a little bit more serious, obviously. But if it's something that can just be corrected right there on the spot or very quickly before the audit opinion comes out, that's what happens. Let's see here. So if this is just going over what I said before about fraud, basically. But if there is fraud that is material fraud, then obviously that has a big impact on the audit. That would be more of a situation where obviously if there's errors in the financial statements based on fraud, that's not going to be as easily or as agreeably corrected by management, especially if management has any part in that actual perpetration of the fraud. Okay, so in terms of documentation, again, this is a big kind of cover your ass moment for auditors in terms of legality and not getting sued. But this is all of the information that needs to be in the audit papers with respect to risk assessment. And really, to be honest, this is probably the most important component of the audit papers in terms of covering your butt, because if you're getting sued, chances are you issued an opinion on financial statements that had material misstatements in them, and you gave it an unqualified opinion. That's what leads to most lawsuits. And so you got someone saying, hey, I relied on your unqualified opinion, I invested in this company, and it turns out that the financial statements were wrong. Okay? So if that situation comes up where you're getting sued for that, then you want to be able to come back and document very extensively how you determined the amount of tests and basically the level of detection risk that you were comfortable with. That's one of the reasons why it's been kind of boiled down, or I should say boiled up more correctly, but more overcomplicated or over-formula, I don't know if that's a word, over-formulafied, it's a word now. But one of the reasons why it's so overdone is because that is a significant component of protecting auditors if they're getting sued later on. So all of these things, yes, but really when it comes to the audit papers, the more stuff you have down there with respect to how you evaluated the risk involved, bless you, the better. I already talked about this. If you find fraud, basically, more often than not, you're going to go to the audit committee about it, assuming that it's not material. And then finally, this is just telling you what I said already, that not necessarily under any obligation to the authorities unless you've been subpoenaed or there's some other extenuating circumstance. All right, that's all the slides I've got, I think. Yeah. Anybody have any questions on these? All right. I'll see you all next week. Hopefully my voice will be a little better by then.